Hello and welcome to CRU's weekly ferroalloy roundup. I'm Alex Anderson, and today I'm joined by Tom Bucic and George Heppel to take a look at what's been happening in the cobalt market. Tom, could you give us a quick overview on what's been happening this week?
Yeah, thanks, Alex. Start of April, we saw a quick rebound, a quite large rebound in the global markets, essentially. In Europe and the US, we saw prices hit very, very, very low prices. I think around $13.50 per pound. And at that level, people were questioning, is this the bottom? Is this the bottom? And finally, we did see a restocking period coming out from the end consumer side recently. So at these current lows, we saw a lot of inquiries pick up as alloy guys were looking to cover on their inventory levels, and it has resulted in prices rising to $16 per pound already. So for now, it just seems like it could definitely reach higher levels, and we have heard offers around $17 already. So let's see if it picks up to the $20 mark once again. But I guess, George, from your side, how are you seeing things for the long term?
Well, yeah, it was certainly it's certainly been a lot worse than expected the last few weeks. I mean, broadly speaking, I think last time we spoke, we were expecting a market bottom of around sort of $15 a pound. Like we discussed before, like the cobalt market has a tendency to move in fives. It's not really sort of cost driven or sort of driven by sort of fundamentals in the short term. So it is driven more by sort of market sentiment and almost sort of psychological effects more than anything else. So it has been a lot worse than expected. But I think the big thing that we've seen over the last few weeks has really been the opening up of a strong arbitrage between Europe and China, actually, which is very unusual for a couple of reasons. First off, because China has been a net export of cobalt for the last year or so, and generally speaking, you wouldn't expect a net exporting market to command such a premium over other markets. And secondly, as well, because Chinese metal is assessed in a slightly different way. It also includes grades like Huayu and Yantai cash and that kind of thing, which generally are less traceable than Western grades, which means that they tend to trade at discounts. When you factor that in, that $4 per pound premium that we see there for China should actually be more along the lines of around $6 per pound when you take into account traceability effects. It's especially telling when you look back sort of November, December, when the discount for Chinese metal was sort of $10 a pound, as much as $10 a pound against Western grades. That sort of considering that the Chinese price was holding pretty strong against over the last month or so against Western Europe, a rise in Western European markets was sort of relatively inevitable, really.
So, George, is this having any sort of impact on the intermediates market?
I think broadly speaking, we could expect some. That ties. There's a couple of questions involved there. I mean, broadly speaking, the intermediates market over the next few months will depend on the stockpiling activity of the refiners in China, and that's largely going to depend on sentiment of how much demand there's going to be for cobalt sulfate and cathode materials over the next year. Now, the Chinese government announced their newest EV subsidies last week. In fact, CRU wrote an insight about it, which is available on crewgroup.com. The long and short of the insight really is that the EV subsidies are worse than expected by a lot of market participants. So, I think there will probably be a lot of players in the Chinese refinery sector who might be a little bit more cautious about buying raw materials, just in case that demand isn't quite as strong as they're expecting. On the other hand, with metal prices where they are right now, I'd expect cobalt hydroxide to be selling for around $8 a pound, which is, is probably as low as it's ever going to get. So, some might decide to benefit from this low price and stockpile at a low level.
Interesting. I mean, George, just one question for you. I mean, do we expect to see European and US sellers try and keep prices below the Chinese difference? Looking at the graph, the Chinese prices did have quite of an impact on in the previous months, in November, December 2018, October. They definitely were pulling prices down in Europe and the US. So what are your thoughts on that?
Yeah, I don't think a premium for Chinese metal is really sustainable. Just for those two reasons, really. I mean, firstly, because China's a net export market, and it's traditionally been sort of the swing producer for the metal market. When the market's short, the Chinese pump out more volume, and then it comes down again. And secondly, because of this issue of traceability. I mean, the way that the prices are assessed in Europe and the US means that really, given that people tends to favour traceable metal over untraceable stuff from China, the Chinese market should be drifting a couple dollars below. Now, whether that means that the European prices are going to jump up to sort of $20 a pound over the Chinese metal prices, or we maybe see the Chinese metal price cooling off a little bit, or they meet in the middle, I'm not really sure at this stage. I'd say, broadly speaking, we could expect the price to sort of approach $20 over the next month or so. But whatever happens, I don't think this premium for Chinese metal is really sustainable in the market in the long term.
No, thanks for that, George.
So from what I'm gathering is that you think that this is probably more of like a short-term blip than something that is a more prolonged trend. I mean, it seems like just from the graph alone that the price trend for cobalt, at least over the last 8 months, has been sort of this cyclical up and down, or I guess gradual decline. I mean, are we seeing sort of the rise back up at this point?
Yeah, quite possibly. I mean, the reason why the Western grades dipped behind the Chinese metal price in the first place was just because I think what happened really was we had a lot of Western metal producers who sort of towards the end of the year were really holding fast on the price, were refusing to sell at lower prices, and then they suddenly got to the end of the year and they were stuck with large volumes of stock that had to be gotten rid of,
yeah.
and that's what really resulted in that sell-off. So it's not necessarily something that's sustainable. It is a short-term effect of this large sell-off that we saw at the beginning of the year, really.
Okay, great. Anything else from you, Tom, on your views?
Well, I mean, I would agree with George at the end of the day. He's pretty much said everything.
Thanks, Tom.
All good. Well, thanks, Tom and George, for the great overview there. For more information on what's going on in the ferroalloy space, please be sure to read the full CRU Ferroalloys Weekly Review that's delivered to your inbox.